loved your book because, Scott, I've lived your book. I think that's one of the problems when I read your book. I'm like, oh my God, he's covered everything. He spent a lot of time on Wall Street. There's a lot of craziness on Wall Street. It's a different sort of crazy than what goes on in Washington. And unfortunately, I got my ass blasted to pieces in Washington too.
No, I'm there now, so.
But tell us why this is so important to investors. Why an investor should read this book, and what could they learn from reading Chaos Kings?
Yeah, well, the book is about Nassim Taleb and Mark Spitznagel, who founded this hedge fund. The first one was Empirica back in 1999, and the big idea that they had was that investors really need to think more about the big crashes and downturns than the daily ups and downs. And I think that's the big lesson to take away from it, is that you really need to think about the 30-40% declines that you could run into, rather than the daily 1% monthly 1% gains, because that's what really matters. If you get steamrolled, it's really hard to come back. That's one of the big lessons that they took away, and I think readers could take away from this book.
Yeah, you have this opening scene. Bill Ackman is about to become obsessed with COVID-19. It's January of 2020. I know Bill well. He's spoken at my conferences. I actually used to cover him when I was a young salesman at Goldman Sachs, when he had just gotten right out of Harvard Business School. He had something called Gotham Partners with David Berkowitz.
Right. Yeah.
You also remember he calls into CNBC to warn people about the potential threat. Tell us about that moment and why you chose to open with it, because it's such a dramatic moment. I mean, just such a great moment. Tell us why you picked that.
Yeah, it really fit in with the bigger themes of the book, because Ackman, he calls into CNBC. He's telling them he's really worried about COVID. He's been worried about it for months, actually, since January. And he says that one of the reasons that he looks at COVID and he sees it as being something that's exponential, something that compounds and gets bigger and bigger. And that's something that I see that certain kinds of people on Wall Street, like Taleb and Spitznagel, look at the world that way. I think even Warren Buffett looks at the world that way, as things that compound and get bigger and bigger. Buffett looks at it as a way to make money, obviously. But it's that framework, that frame of thinking, of seeing things that can hit this exponential level, that he looked at COVID and saw that as the risk, and it's something that's going to spread and get bigger and bigger. And he was saying, I don't see why this doesn't go everywhere in the world. When you think about compounding, exponential compounding, that's what you've got with COVID. And that's what he told people. And that's what, Taleb, the black swan, that's something that's exponential or super exponential, something that compounds and gets bigger and bigger. And I saw, Ackman, it was really interesting to me that Ackman talked about that on that call, because that's, I initially, I went to this book with looking at what Nassim had written about and the black swan, and that's obviously a big part of it. And then I went back and listened to Bill's call and saw that's actually his framework of looking at the world. And that's what alerted him to the risk in ways that other people might not really have seen so early on.
I guess the question I have, I just want to step back, because is COVID a black swan to you? Is COVID a new development that's potentially recurring? I mean, meaning, if you said to me, okay, we had a pandemic in 1919 or 1917 to 1919, and now we have a pandemic 100 years later, these are black swans. But David Quammen wrote a book about this a few years ago and said, well, the population of the earth is just sort of expanding, human population being what it is, and it's encroaching upon the animal world. And we're going to get all of these cross viruses now from other mammals. So Is this something that's not a black swan in your mind, or is it? Or do you think that we're going to resolve this and this mRNA technology puts this stuff behind us? What's your thoughts there?
No, I think that definitely not a black swan. I mean, it's something I write about in the book is how Nassim and others had been predicting this as a coming risk for years. Nassim had been working with some theorists who'd been going back into the 2000s, looking at how increased transportation was causing what one researcher, one of his collaborators on a paper, Yanir Bar-Yam, called the transition to extinction, which is a kind of a scary title for a paper. But the idea is that the most virulent viruses, something that might break out in Africa or elsewhere, often die out because they kill the local population so quickly that they don't spread. But with increased transportation through vehicles, through population growth, through air transportation, that era is coming to an end. So the risk that we're reaching this point, and I think we saw it with COVID, is that these very deadly viruses have a much higher likelihood of breaking out of that area and moving to the general population. So yeah, it's something that people have been predicting for years. I think that the reaction in financial markets in early 2020 was black swanish because things, as I'm sure you saw, got extremely crazy. With oil prices going negative.
Mm-hmm.
I mean, I think that talking to people in the markets back then, some were saying it was even more insane than 2008. But I think we forget that because things bounced back so quickly with all the liquidity that the U.S. government and the Fed put into the system. We bounced back very quickly. But we did have an extreme financial breakdown in that area, in that after COVID was really spreading.
Yeah, it always. I mean, it just. I mean, my business, frankly, is still recovering from it. I mean, we got blindsided by it. I didn't take it as seriously as Bill Ackman in the beginning. I got it wrong, frankly. I left a dinner at the World Economic Forum, Scott. There were two WHO, World Health Organization guys there telling us that they had it under control. I can tell you that every hedge fund manager that was in that dinner with me got smoked in the month of March. Okay. Myself included, by the way. So, it's the more humbling life is when you realize how little that let's talk about Nassim for a second. A brilliant philosopher. Is he a great trader in your mind?
I think that he came up with this idea of he and Mark together, but they both kind of came up with it separately, and then they met in 1999, and it was sort of this ideal meeting of the minds to make these bets on extreme events that you can lose a little bit of money on, but you can't blow up. And I think that was a brilliant concept. Mm-hmm. Nobody else had ever come up with that idea as a separate strategy. Some might have, it could be, it probably was part of some hedge funds as a hedge strategy. So they were the first to come up with this idea of a tail risk, singular tail risk hedge fund. Yeah. And, so I would say that does put Nassim in the category of a great trader. Coming up with what became an asset class in its own right. Many people have tried to imitate it. I'd say that where Nassim sort of falls short is that he can't take the stress of operating that strategy day to day.
Emotional. He's got the genetics of all of us on the Mediterranean. I spent my career selling and been in relationship management. We're too emotional. He doesn't have the cold-bloodedness necessary to do this stuff. Let's talk about, and I'm not going to pronounce his name right, but I read about Didier Sarnet in your book. I think hopefully I'm pronouncing it right. Totally different view than Nassim Taleb. Tell us about
Yeah.
his opinion of disasters. Nassim thinking, geez, big disasters you can't predict. But Didier sort of has this view that yes, you can. Tell us what his theory is.
Yeah, picked Didier as a sort of a counterpoint to Nassim, and Mark's strategy, which is Nassim and Mark basically say we can't predict anything. It's just too hard. It's a fool's errand, to try to predict markets. Whereas Didier, he's a very smart guy, mathematician, physicist, um, came to believe that there were signals in the market that would indicate a coming extreme event. And he actually based this on some work that he'd done in the 1990s, looking at the explosion of rockets. And, there were signals in what was going on with these rockets that would indicate that one might blow up. Using the same math, he applied that to markets. And it's very interesting to look at the success of that. I mean, it does seem like he's got some skill in predicting when certain asset classes or commodities or indexes or whatever are entering bubbles. It's really what seems to be the case is it's really hard to trade on that, because timing is so important. If you try to short a bubble, it's in a bubble, but you're wrong about the timing, you can get wiped out, And so I have this scene in the book where it's Nassim and Didier actually debate one another in New York in, I think, 2015 or something like that. And it's really interesting to see how Nassim is saying, like, all right, what you've got here is really interesting and smart and clever, and I like it. It's not a way to manage risk. It's it is risky, and what Didier is doing is speculation. He's trading. He's not managing risk, which is that is actually the job of a hedge fund manager is not to be a speculator so much as it is to manage the risk of your client's assets in the most efficient way as you can.
Very, very, very. I mean, great insights. I mean, your two other books, The Quants, which looked at the world of quantitative analysis, and then Dark Pools, which was phenomenal because it really described the rise of the bots and the machine traders. But this is a different book. Yeah, that was more. Those books to me were more about using technology and robots and faster speeds and so forth. But this is really about human personalities. And so I want you to juxtapose for us for a second the technology books, which I would call the machines of Wall Street, and the personalities. We're always going to have the personalities, aren't we, Scott? Or what do you think? Do you think the Terminator is going to take over Wall Street?
Probably already has. That's one of the points I'd try to make in Dark Pools is that's the direction we're going is, high frequency trading, and AI were moving together in a way that was going to just sort of eventually eliminate the human element in the market. And I don't see that as a good thing. We're not there yet completely, but we're getting pretty close. So yeah, I mean, even in the quants and dark pools, there are plenty of personalities. Maybe not anybody as large life as Nassim Taleb. This book was Chaos Kings. Was the idea of it came to me in sort of the dark days of 2020 when things were obviously just completely insane. It's almost hard to remember how, just disorienting and crazy it was. And what I saw was, Universa. And so I've known Nassim and Mark for a long time, since 2007, actually, is when I first met them. And I've tracked I've first reported a lot on their hedge fund, Universa. and their early successes. And I've just stayed in touch with them for all these years. And so it emerged with press reports in early 2020 that Universa had clocked this return of 4,000% in just a few months. And this was at a time when everybody else was just blowing up. Like
Right.
as you talked to, people were not ready for this.
Right.
And also at the same time, Nassim had written a paper in January of 2020 warning about the risks of COVID and how dangerous this thing was, and the extreme measures that people need to take to protect themselves against it. And I thought there's something really interesting here. There's something about the way these guys look at the world that allows them to come out looking kind of smart, and successful in a period where everybody else is just getting their ass kicked. And there's got to be, what is that? What is it about their worldview that lets them get through these periods of just utter catastrophe, smooth sailing, basically, as opposed to everybody else? And that's kind of what the initial idea of the book was, to try to apply that to all sorts of other risks.
And I got that, and I certainly appreciate all that. I guess the question I have for you, though, is it, and maybe Talem is right about this. I mean, he writes in his first book about the Russian roulette, right? If I spin the dial, I put the gun to my head, and I click it and I don't die, they're going to hand me $10 million, and all of a sudden I'm super smart. So meaning, is it just a random series of monkeys sitting at the typewriter, and there's just one person that hits the typewriter keys in a way that wins when the others are losing? Or is there something about their temperament where you're like, okay, that is a distinctive edge? Okay, so somebody like me, for example, you have me believing that this is about their temperament. So is it random or is it temperament?
I definitely think that there's a strong element of temperament in that, and in being able to execute the strategy, especially with Mark. We talked about how Nassim he's brilliant. He's had this great strategy, couldn't live with it, doing it day to day. Whereas Mark has just been, training to execute the strategy ever since he was a teenager. When he was learning how to trade on the Chicago Board of Trade under this veteran commodity trader who basically taught him what you have to do is love to lose. And what that meant was, if a position starts moving against you, just get out of it immediately and learn to trade another day. And, the commodity trader told Mark, this is against human nature. People want to believe in their positions. They want to hold on. You can have all sorts of research that backs up, that you're right and the market's wrong, when in fact the market is never wrong. And you need to just be able to discipline yourself. And that's what Mark has, is he's got the discipline to stick with it. It's a very hard strategy to execute, even though you may know that eventually it's going to, win for you. This is a strategy that can lose money for years, year after year. And in Wall Street, the incentive structure is basically, make money every year, no matter what, because the incentive is the bonus for most traders and hedge funds. And if you've got, by the way, year after year of negative returns, your investors are going to give you the boot.
Right. No question. I mean, look, but it's also, there's a great expression on Wall Street that I grew up with called fast pay makes fast friends. And so you have to always, you're only as good as your last trade.
Yeah.
I want to put this in historical context for a second. Diana Henriquez, she wrote a book a few years back called The First Class Catastrophe, and it was about the October 19th, 1987 stock market crash and this sort of confluence of events that led to a drop of 22.5%, worst day in market history. Now, the markets, of course, recovered. It didn't end up like the 1929 crash by any means. But I'm wondering today, is the world so different? This introduction of the quants, the dark pools, the chaos kings, Is the world different, or will we see this continued historical oscillation of the stock market, irregardless of the new technologies and the new temperaments and the new people?
Well, I think that we've seen within the past in 2000 we had the dot-com blow up. In 2008, global financial crisis. Throughout the 2010s, multiple financial crises. 2020, the COVID crash. We had in 2010 we had the flash crash, which was, my contention is it was caused by high frequency trading. And I actually reported on that the day it happened. So I see us entering a phase of increasing financial volatility, and exacerbated potentially by the computers, which can kind of run in these doom loops and cause things to accelerate beyond our control. It's an entirely new market, and it's hard to really say. I mean, the contention of the high frequency group is that they actually reduce volatility, and that's probably true on a day-to-day basis. But there also is this risk, as we saw in the flash crash and some other extreme, 2020 events, things cascading very, very rapidly. And that's what I've always been concerned about, is putting the computers in control. You remove the sort of, rational human ability to intervene and slow things down. And, you talked about 1987. It's kind of ironic. That's when the computers started getting put into the market.
Yeah, the program training. Yep.
Yeah.
You remember the portfolio insurance?
That's portfolio insurance is, that's
it's
actually
sort of
what
cascade of selling as they were trying to defend themselves.
Yeah.
Scott,
yeah, sure. Go ahead.
I'm at the portion of the podcast where I present 5 words to the author, and then you respond. You can either give me a one-line sentence, a word. You can give me a paragraph. I want to get your reaction to these 5 words. Okay, you ready?
Okay.
Universa.
Very successful.
Yeah, incredible, right? So this is Spicknagel's firm.
Yeah.
Did we talked about him, but I'd like to get your summary. Didier Sarnet.
Very smart, not such a good trader. He's I think jealous of Nassim's success, which is something I've come across a lot.
Well, we have people that do that to each other. Unfortunately, that's a wasteful preoccupation to be jealous of others. Quant. When I say the word quant, what do you say?
Smart but dangerous.
Yeah, but sometimes they think that they're smarter than everybody else, right? I mean, they get a little bit. Yeah, they get a little bit of hubristic. But what if I say the word bots?
It's funny. I've thought so much about it that my brain kind of went in a loop. Same as quants, smart but dangerous, but also unpredictable.
Yeah, it's interesting, right? I mean, we unleash these technological beasts on the society, and we expect them to act differently than human beings. And so we're expecting something that invariably doesn't happen. What about if I say the overall stock market? What's your opinion there?
The stock market is the essence of capitalism, and it's a fascinating barometer of the day-to-day health of the economy, but it also can be extremely irrational and not reflective of underlying fundamentals, which is a fascinating thing that when I first started covering Wall Street in the early 2000s. I came out of this tradition of like, I have a degree in English, not economics, and I came across this idea that financial markets are rational and perfectly reflect the ongoing economic realities of the world. And it seemed completely counterintuitive to me. I look at financial markets and I see greed and fear, and not something that's totally rational. So that's what I think of the stock market is: greed and fear.
It's great. It's great stuff. What's next for you, Scott? What are we working on next? Are you allowed to talk about it?
Well, I covered climate and climate technology for the Journal, but I'm also, I'm pretty interested in this Trump January 6th case. And so last year, I was the lead reporter for the Journal on the January 6th hearings. So I'm kind of interested in following what's going on with those cases, as
Right.
you might understand why.
Right.
I'd be curious to get your thoughts about what's the fate of the former president with these cases.
Well, I can give you my editorial opinion. Obviously he did misdeeds, and if he were not president, anybody else would be locked up for some of the things that he did and the premeditation. And they have witness accounts of him planning this level of violence. Some would call it an insurrection, some would call it a protest, whatever it is, he was involved in it. And so there's levels of criminality there. Not that there should be a two-tier justice system or anything like that, but I think it's very difficult for us. The founders didn't really figure out how to handle rogue presidents other than through the process of impeachment. McCarthy and McConnell and Pelosi had him on the ropes on January 7th. They could have filed for the impeachment and have vacated him from the office, and Pence would have been the president for the last 13 days, and they would have had him dead to rights. But they quaked under the power of his political tribe that is ardent to him, that doesn't move no matter what he says or does. He was right. He could shoot people on Fifth Avenue. Yeah. So my editorial comment and my prediction is he will not go to jail. He will be disgraced through these indictments, particularly the J6 indictment, which is compelling, as you know, because you've reported on it, and damning. But he won't go to jail. They won't put the former president in jail. I think it's a slippery slope for us, because it's you then start creating jail cells for your political adversaries like they do in these other countries. And I don't think the United States wants to be known for that. And I'll say this to you, and this is a reflection from Teddy Kennedy. In September of 1974, he excoriated Jerry Ford for pardoning Nixon. He said Nixon needed to pay for the crimes by going to prison. And so the pardon, he said, was specious and quite costly. 35 years later, when he was dying, he wrote in his last memoir that Jerry Ford was right. Upon reflection, in order for the country to heal, even though we had this rogue and this criminal actor, because of the office and the institution of the presidency, we had to find a recourse. And I think that's ultimately why the Romans came up with the concept of pardoning people, Scott. So you asked me the question, so I'm answering it. He's a criminal, but he's not going to go to jail, and he'll find a way to squirm him out of this thing. I guess the real question is he going to be the Republican nominee for the presidency, and is he going to win the presidency? And of course, so many variables before that happens, but there's a chance that could happen, and we have to prepare the country once again for this sort of nonsense. So.
Yeah, well, I think definitely he's going to be the Republican nominee.
Right.
It's
me too, by the way. I think it's inevitable unless he does, which I have said, which is a contrarian move, is that he cuts a deal somewhere in here, and he's exhausted by this. His family's not into it. Fakes an illness, and he bows out, but he doesn't go to jail. We'll see. There's a combination of things that could happen, and you're also in a scenario where Biden and Trump are not the nominees. If you told me right now that we had Gavin Newsom or Phil Murphy running against Glenn Youngkin, I'm not going to be surprised by that. I'm not saying that's in the highest level of probability, but I'm not saying that that's a zero probability either. So we'll ski. But you wrote a terrific book. It's called Chaos Kings: How Wall Street Traders Make Billions in the New Age of Crisis. I'm recommending it to people, and I really appreciate you joining the show today, Scott. Thank you.
Yeah, well, thanks for having me on, Anthony.
How you create a crash. Speculation. Hoover ever missteps in economic policy. Banking, Wild West in the banking. Take us through the base ingredients and tell us if anything is different today. What should we be worried about?
The match that lights the fire every time. And I would argue effectively that in 1929, it was margin loans. Now, you said, could it happen again? And where are we today?
Welcome to Open Book. I am your host, Anthony Scaramucci. Joining us now is the world famous and very talented Andrew Ross Sorkin. Title of the book is 1929, The Inside Story of the Greatest Crash in Wall Street History. Andrew, welcome to the show. I love our relationship, and you are very famous for many reasons, but you're also the best-selling author of Too Big to Fail. But what drew you back nearly a century to write the 1929 crash?
I mean, the truth was that I didn't know enough about the 1929 crash. I'd written about 2008 and the financial crisis, and people would always ask me to compare the two, and I didn't always have a great answer. And I think most people that I know sort of have only a vague conception that something pretty terrible happened back then that led to the Great Depression. And I always love books, I think like you love books, about people, about, you know, those great books that put you in the room with those people, Barbarians of the Gate, Den of Thieves, all those kind of, inside the room kind of books, fly on the wall kind of things. And I thought, wow, could I try to do that to this?
Listen, I was enthralled by the different characters in the story. You know, I had read Lords of Finance by Liaquat Ahmed maybe
Fabulous book.
15 years ago. And you referenced it a little bit in here. I read Galbraith's Crash, but that was like when I was in college, so
Yep.
I didn't really have
Also a great book.
lot of memory of that. But let's set the scene, though, because, you know, when I closed your book, I took some notes, and I said, okay, what did I learn from Andrew's book? Greed always overcomes wisdom. I think that's one of the number one things. You had tremendous excesses going on in the late 20s, okay, as it related to margin and the use of margin. And then you had an insider grab bag, which was legal at the time,
Right.
but the insiders were sort of moving things around in a way that the outsiders could never have been able to have taken advantage of, right? So guys like Joe Kennedy got out of there barely unscathed, right?
Pretty much you got it right, with one extra feature, I think, which is set against a backdrop of just wild euphoria. So I think it's the debt piece, meaning just the amount of credit and leverage in the system. That to me is the match that lights the fire. There's always some semblance of euphoria because by default you have to get sort of a speculative frenzy going. And then when you sort of don't have enough transparency in the system, when you have people manipulating and doing all sorts of shenanigans, charlatans and frauds and everything, it gets complicated quick.
All right. The other thing I got out of the book is that these were like patricians. These were waspy people living in the
Yes.
Fifth Avenue salons. They were living in Tuxedo Park. They were summering in Newport and hanging out in Greenwich. I mean, this was not, you know, these were not like old school, like when you think of like the mob and Al Capone back in the 30s. This was a different style of crime, right?
This was a totally different style of crime, and the truth was it really wasn't crime. I mean, because there was no rules. I mean, I think about this all the time. You know, sometimes I wonder what I would have done back then, or you would have done back then, or any of us would have done back then. And not to excuse the behavior, because I think as you read it, especially in the context of today, you'd say, oh my goodness, this is criminal, this is wrong. At a minimum, this is immoral. But I always have found that one of the things that's so interesting about the markets is it's a business of people who think they're trying to outwit somebody else, right? Whoever's buying a stock thinks they're smarter than the guy they're selling it to. And whoever's selling the stock thinks that they're smarter than the guy who's buying it from them.
All right, so draw an analogy to today. Okay, so you obviously you were influenced by your research on Too Big to Fail. You know, what's interesting, I finished this book about 2 weeks ago. and I read Too Big to Fail about, I don't know, 12 or 13 years ago. So I went back and reread that book as well.
Oh, God
And,
bless you.
and the it was interesting because you definitely took the elements of that book, the motif, the
Yes.
individual stories. You're in the boardroom, you're talking to the people's spouses, you're talking to the people's friends, and you got a lot of interesting characters in this book, Winston Churchill, et cetera. But I guess the thing that I was it took me aback about this book is that it wasn't really just a single day event. It was like a slow motion crash leading up to the event. So tell us a little bit about that. Tell us about some of the things that went haywire while the fuse was burning in the
Well, that's
late
the well,
1920s.
that's the thing that I think is oftentimes misunderstood about 1929 and frankly the Great Depression. And I will say it was my own misunderstanding too. One that, it wasn't just that there was one, horrific crash. It really was this sort of slow motion situation. In truth, sometimes people talk about Black Thursday, Black Tuesday, Black Monday. There were a lot of black days. I mean, like a lot of black days. And in fact, the stock market effectively fell. And when you really think about the fall, close to 50%, but really between the months of October and middle of November of 1929. So it wasn't just one moment. But then, oddly enough, by the end of 1929, the stock market was actually only down 17%, which I know surprised me. Didn't even make the lists of some of the most important stories of the year. And that's because I think there was a misunderstanding in that moment of actually how many families were just completely wiped out because of the leverage and debt that they had taken on. So it wasn't just that the stock market had gone up 50% and they could hold their stocks at, and the equity value had gone down. It's that they were all getting margin called and having to sell their homes and mortgage their houses and, had lost everything. And then it wasn't even just that the crash itself was somehow going to impact the economy by itself, which it was, but didn't have to be the Great Depression. It was really the first domino of then a series of policy choices. And I try to put you in the room with Hoover as well, and with Andrew Mellon, his Treasury Secretary, and inside the Fed, and then Roosevelt, and you see just the mistake after mistake after mistake that they made that made the whole situation that much worse. Everything from raising taxes to implementing tariffs to the Fed, obviously, trying to hold on to the gold standard. I mean, well, the president was trying to hold on to the gold standard. The Fed, wasn't flushing the system with money the way, frankly, Ben Bernanke did in 2008, which I think was, by the way, one of the lessons that he learned when he did his PhD at Princeton about the Great Depression. So I think you're sort of looking at a story that's not really just about 1929. The story, and I had intended actually when I first began the project, I thought, oh, the book's going to start on February or January 1st, 1929, will end at the end of the year. And I realized really to tell the story, you really had to, the full breadth of it, in fact, goes at least through 1933, and at least the way I've tried to tell it, actually all the way through 1940.
The two big players to me, and you mentioned Benjamin Strong, of course, who passes away. He's the first Fed chair.
Right.
He passes away prior to the crash, and Ahmed in his book and you in your book suggest that he probably would have been a little less tight on the Federal Reserve reins and probably would have created more laxity and more liquidity had he
Right.
not passed. So, right. So there's a little bit of a single man theory here, but let's go to Hoover because, Hoover, basically the way you describe him, I was thinking, geez, we could have had a monkey flipping coins and we at least would have gotten half of the decisions right in a coin toss, but he was going 9 out of 10 for getting decisions wrong. So talk about him, some of the mistakes he was making. And by the way, he was a great guy and a very classy guy, and he made a lot of money, and he was a charitable guy. He did all those things, the food programs for veterans and stuff, but he really got this wrong. He had a terrible blind spot as a presidential leader. What was that?
Well, the biggest blind spot was that he really believed that the stock market was somehow disconnected from the real economy. I mean, that was probably his number one mistake. He also thought somehow that it was, that he had the ability, which he did not, to jawbone his way out of it, which was, this idea that he could sort of tell the public something that actually wasn't really happening and tell them basically go put a smile on your face and that they would have a smile on their face. By the way, this is sort of akin to what was going on, when President Biden was telling people that, there was no inflation in the country, and like they didn't understand what was happening. People felt it. and they felt it in 1930, 1931, 1932. Hoover implements these tariffs, which every economist in America is telling him is a terrible idea, in large part because back in 1928, when he was trying to win the election, he went around telling farmers, I'm going to try to protect you. I'll put tariffs in place if you elect me. So he felt that he needed to make good on his pledge. Again, sort of another terrible mistake. He was also being advised by a guy that, frankly, he didn't really like that much, Andrew Mellon. But Andrew Mellon was a true capitalist in the sense that his view was, if you made a lot of money, great. And if you lost a lot of money, great. So I think there's a whole bunch of things going on along the way that just really unraveled things.
Going online without ExpressVPN is like forgetting to mute yourself on a Zoom meeting. Do you really want your coworkers to hear you trash talking them? Because all your traffic flows through their servers. Internet service providers, including mobile network providers, know every single website you visit. It's terrible. And in the US, ISPs are legally allowed to sell that information to advertisers. ExpressVPN reroutes 100% of your traffic through secure encrypted servers, so your ISP can't see your browsing history. There are 3 reasons why you need ExpressVPN. Hide your IP address, which makes it extremely difficult for third parties to track your online activity. Number 2, easy to use. Just fire up the app and click one button to get protected. And 3, works on all devices, phones, laptops, tablets, and more, so you can stay private on the go. Select plans include Identity Defender, a new suite of tools to get your data removed from data brokers, alert you when your data appears on the dark web, and even insure against data theft for up to $1 million. Rated number 1 by tech reviewers like CNET and The Verge. As an avid traveler, ExpressVPN is an indispensable tool for me. I never fly or use public Wi-Fi, whether at an airport or a coffee shop, without it. Secure your online data today by visiting expressvpn.com/openbook. That's expressvpn.com/openbook to find out how you can get up to 4 extra months. expressvpn.com/openbook. I mean, listen, there was a great biography of Mellon too, maybe about 15 years ago. The hatred that Mellon had for Roosevelt and vice versa was another great element to this story. So Roosevelt comes in and more or less does the opposite of Hoover, right? So take us through some of the steps.
Well, that's actually, I mean, by the way, I'm so curious how you think about it, given how much you know about presidential transitions and the like. One of the things that could have prevented some of the bank failures, and by the way, we ultimately had something like 9,000 bank failures in America, was that Hoover really did understand by 1932, now 32, 33, he was late to the party, that he needed to try to bail out the banks. He needed to try to declare a bank holiday or do something relatively drastic to try to save the banking system. But he was so, what's the word? He almost refused to do it.
He was doctrinaire. He was a very doctrinaire guy. He had, he was the opposite of George W. Bush, because in Too Big to Fail, you have this great scene where Bush is talking to Paulson, and Bush is like, well, I'm a conservative. I don't want to do that. And Paulson's like, okay, well, the whole system's going to blow up.
Right.
So then Bush says, okay, then we're going to do that. That's a left-leaning strategy to dump $1 trillion into the banks. But it felt like Hoover was, he missed the beat there with that, right?
I think he was both doctrinaire,
right?
but also embarrassed, to be honest with you, because to some degree, because he had told people for so long that there was no problem, I think it was hard to go back on that. I think that's one of the reasons he was so desperate. At this point, he's now lost the election, knows they need to do something about the banking system, and he goes to Roosevelt secretly and begs him and says, look, I'm going to go do this. I want to do something, but I want you to approve of it. I need you to endorse it. Otherwise, the public is not going to buy into it. And of course, Roosevelt basically just lies to his face and says, well, I'm not doing that, and I'm never going to do that, basically. And of course, Roosevelt's saying that to Hoover because the truth is that he does want to do all those things, but he needs a clean slate. He doesn't want to be attached to this, Hoover doing it first. But as a result, they lost actually some serious time and, frankly, hundreds of banks probably as a result of it.
Yeah, which caused a further contraction, right?
Right.
And the other thing, you were great on the concepts of deflation in this book. I mean, the deflation in the economy, we always talk about inflation, Andrew, but deflation destroys debt-laden economies because you just can't pay back the debt, and you watch these people get back their farm equipment or turn back the keys to their capital equipment, their houses. I mean, it was just absolutely devastating. But, you mentioned presidential transitions, they're very similar. Egomaniacs are fighting with each other, and they don't want each other to get any credit for anything. And it was exemplified there. I guess the story between Wall Street and Washington, like when I read your two books side to side, I'm like, wow, I mean, that clash has been going on for 100 years, and it's the same story.
It's the same story.
The Wall Streeters feel like the Washington people know nothing. The Washington people feel like the Wall Street people are just greedy pigs feeding at the trough. Both feel slighted by each other, right? Take us into some of that intrigue.
Well, look, I knew that I could write this story, or thought I had an opportunity to write this story when I began to fully form and appreciate the story between two, I think, very unique individuals in the context of Charlie Mitchell, who was the CEO of National City, which goes on to become Citigroup. He was running what was the biggest bank in the country. He was sort of he was as famous as Jamie Dimon, but probably less conservative than Jamie Dimon in terms of how he thinks about the market. Call him Sunshine Charlie. He used to always say that he thought we should sell stocks the way we sell neckties. So he wanted to sort of demystify finance. And he was largely responsible for really almost creating the credit market so that people could buy stock on margin. And people were doing this, 10 to 1. You put up a buck, they'd give you they'd loan you $10 because of Sunshine Charlie. And on the other side of the story, and this is where I really thought, okay, could be the spine of the story, the clash of these egos, is a guy named Carter Glass, Senator of Virginia. I think a lot of your audience will know him better because his name is attached to the bill that ultimately breaks up the banks in 1933. But Carter Glass was the Elizabeth Warren of his time, and he was railing for years about this thing called Mitchellism. I mean, he used to call it Mitchellism, how he believed Charlie Mitchell and Wall Street were going to just ruin the economy, that speculation had gotten out of control. He was trying to come up with every, possible way to, damp down some of the speculation. At one point, he was proposing ideas to, put taxes on, stock trading to end speculation, for example. And interestingly, he did have a sense. He was a smart guy. He understood the economy and finance pretty well. He was largely responsible, actually, for the creation of the Federal Reserve and the bill that actually put that in place back in 1913. And so you could sort of see the Washington Wall Street fight through the prism of those two individuals.
So, Andrew, I love that story about Mitchell, by the way. I followed it right to the end and, his eventual exoneration at trial, but also just the things that he went through and the reputation damaging. And the way you wrote about Lamont and JP Morgan's son, is classic, right? The one guy's working, the other guy's like a dilettante, doesn't want to get his hands dirty, right? I mean, it's just everything that you and I have experienced in life. But I want to talk in a Dr. Frankenstein sort of a way, okay? In terms of like how you create life, Mary Shelley, Dr. Frankenstein. But I want Andrew Sorkin to channel how you create a crash. Speculation, Hoover era missteps in economic policy, uh, banking, Wild West in the banking, fractional banking system with the Wild West, and the people don't even understand if they put their money in the bank, they could lose it if the bank has credit missteps. Take us through the base ingredients and tell us if anything is different today. And if it isn't different, what should we be worried about?
Okay, so look, the match that lights the fire every time you saw it you read Too Big to Fail or you reread Too Big to Fail. The match that lit that fire was too much leverage in the system in the context of subprime loans.
Leverage and confidence, right? Because you
leverage
had
and confidence.
Subprime loans that were AAA rated.
Yep.
People are like, well, I'm going to get the money back. I'm going to just keep leveraging them, right? The CDO market,
exactly. And I would argue effectively that in 1928, in 1929, it was margin loans. It largely was margin loans. Now you said, could it happen again? And where are we today? The good news in my mind is, look, there was no SEC back then. Even if you think the SEC is not doing a lot right now, still exists. There are people who are hopefully monitoring some of this. So some of the shenanigans, I like to think, aren't as significant as they were then. By the way, there was no bank capital requirements back then. There was no rules. There was no insider trading rules. There was no nothing. So I like to believe that, yeah, we can have corrections. We can even have crashes, but they don't have to turn into depressions. So could you have a crash like 1999? Sure. Could you have a crash even like 2008? Sure. But in both instances, we did come back a lot quicker than obviously what took place in 1929 and then ultimately 30, 31, 32. And I think part of the answer is we've also learned that in those moments, you do flood the system with money. Now, one difference that is very different today than even 10 or 15 years ago or 1999 or before, which I haven't really, I don't know the full extent of just what the implication would be, which is U.S. debt is so large that it might make it more and more complicated to throw money at the problem. So here we are back in 1929. There was a budget surplus, by the way, back then. We hardly had any debt. But I think the biggest thing is leverage, and the biggest thing is where's the leverage and knowing about it and having transparency around it. And I do have some worries today about those issues. So we have the euphoria and the AI bubble that's clearly taking place. There's indiscriminate spending. I think everyone would agree with that. Then the question is, where's the leverage? And is there too much leverage in the system? And I think partially because of private credit today, which is to say that so much of it is in the shadows, I don't think we know right this moment. I don't know. What do you think?
Well, yeah, I mean, I'm worried about it. I mean, one of the analogies that you brought up that had me worried was what the Federal Reserve was doing in 29. They were tightening credit after the bubble had already formed. Jerome Powell is sort of, he's taking balance sheet back, right? He's shrinking the balance sheet at a time where you've got an explosion in corporate debt. I mean, it's record
Right.
corporate debt, and it's direct corporate debt. So it may not hurt the banking industry, but it'll collapse the credit markets, which will seize the economy, right? I mean, so I'm worried about that. I'm also, the thing you also brought up, which I want to reference, is the inequality. So I think the numbers you used in 1929, it was like 25% of the 1% controlled 25% of the
Yes.
country's wealth. But today, Andrew, doing the calculation, it's a little bit over 30%. And so I'm wondering if that extreme inequality, okay, is hurting the country. Like, for sure, as an economist, the extreme inequality actually hurts innovation, because what happens is the rich just sit on everything,
Right.
and then they pay the government not to break them up, right? So, they sit there, they lobby the government, don't break up my Mag 7 company.
Right.
And even though the irony is breaking up AT&T enabled us to create the Mag 7, they don't want to get any breakup, right? So when you get wealth concentration, you weirdly get a lack of innovation.
So I think not only are you right about that, there's one other feature of it, which is that once you get into a serious inequality situation, people start to be desperate and start to ordinary individuals who are suffering from the inequality part of this take risks that they otherwise would not, right? A lot of what was happening was people really wanted access to the lottery ticket. They
Right.
wanted to buy the
Right,
lottery
exactly.
ticket. And, the truth is that when most people buy a lottery ticket, most people lose. And I think that's actually, a big feature of why people were making some of the bets that they were making in the late 20s. They saw people making money. They wanted in on it. I'm curious where you land on this. I think there's a lot of people who've actually, and by the way, they've benefited from this. They've looked at Bitcoin and crypto as a lottery ticket for themselves. And actually, so far, on the whole, if they did it early, it's paid off in a very, very big way. But there's also a lot of leverage in some of those trades. Look at some of those interesting option markets around Bitcoin and Ethereum and some of these others with it. You could do it for 20 times, 50 times. I mean, I don't know how much of a big piece of the market that is in crypto, but obviously crypto was something that didn't exist in 1929.
Well, listen, this is me interviewing you, but I will interject here a little bit and tell you that was the first thing I thought of when I closed the book. Where is the Wild West right now? The Wild West was the stock market in 1929. The Wild West right now is the unregulated crypto market, in the unregulated global crypto market. Now, the good news is it's only about $4 trillion. So if the whole thing implodes, it'll be painful, but it won't destroy the whole system. But I'm going to say something in praise of Gary Gensler. Okay, you ready? Buckle up,
Okay.
buckle
Oh
up.
my
Okay,
goodness.
right. In praise of Gary Gensler. Okay,
Okay.
get your seatbelt on. So weirdly, by being politically motivated and blocking the cash or the spot Bitcoin ETF, like when I took administrative law, and I've come on your show, the futures ETF is approved in November of 21. You would look at administrative law statute and say, okay, though the cash one will be approved within 6 months because it's the goal is not to be arbitrary or capricious. But Gensler shuts it down. Okay, he's very politically motivated. He loses the court case as evidence of how politically motivated it is. But weirdly, he sets in motion the car crash of Three Arrows, Sam Bankman-Fried,
Right.
those blockchain lending companies
Right.
all imploded. And he took so much leverage out of the system that when it was time to get the ETF approved, like when BlackRock got its ETF approved, he had strained all the excess out of the system. Now that excess is building again. So I'm worried about it. You're worried about it. I think smart people should be. But weirdly, we could still be living in a world of Sam Bankman-Fried because maybe that floating of the ETF would have masked over some of the nefarious things that he was doing, right?
Right.
So
That's interesting. That's interesting.
It's just look, my colleagues in the industry probably get pissed at me for making that comment, but I think he weirdly helped the industry survive because there was a lot of nefarious things, a lot of 1929 things going
Right.
on in the industry due to the lack of regulation. So, all right, well, we're down to the last 5 minutes. So what I do with my producers, Andrew, is I come up with 5 words,
Okay.
or 5 thoughts. We cull
Okay.
them from your book. Okay, so you have to. It's almost like a Rorschach test. I'm going to say the thing and then you respond. Okay, you ready?
Here we go.
All right. I say the word crash. You say what?
Pain.
Okay. I say the 2 words, Wall Street.
Complicated.
Complicated. All right, give me one more sentence. Go ahead.
Matching of wits. Matching of wits.
See, when I hear the word Wall Street, I think of good and bad. There's
Well,
there's
that's
arterial.
what I'm calling complicated.
Right. Arterial structure, flow of capitalism creates innovation. But then there's a lot of riffraff in Wall Street, as we both know, right?
But that's the thing about all of this, which is, you read a book like this and work on a book like this for all this time, and you start to think, okay, you're going to become like a Cassandra. But the truth is that it's been much more profitable to be a professional optimist than a professional skeptic over the last 100 years.
No question. All right. So we did Wall Street. Let's keep going. And number 3, let's say the word Washington. And I don't mean George. I mean DC.
Mistakes.
Yeah.
That's my word. Mistakes.
So you see, everyone calls Washington a swamp. I see it as a gold-plated hot tub. I think these guys sit in the hot tub and they pass the Cubanos and the Cristal and they hang out together. And if you're with them, you sit and bubble up in the hot tub. If you're not with them, they throw you out of there. It's just, it's a.
I don't know. Maybe they've installed a hot tub in the White House. I don't even think it's that fancy, though.
It's an ugly place. Let's just put it that way. Okay. I
You
got
spent
my
more time there than I have.
I got my 11-day PhD on how bad it works. It's ugly. All right. I say 2008. You say what?
You say 2008, and I say sequel, as in sequel to 1929.
Yeah, I say a rhyme. A rhyme.
A rhyme.
Right? History doesn't
rhymes.
necessarily exactly repeat itself, but it was rhyming with 1929, right?
100%.
Okay, so I hear the word a rhyme. Here's 1929. I'm going to end with that. I say the words 1929, and I'll give you the last word. What do you say?
Hold on. You say 1929. What do you think?
I say 1929. I want to hear what you think first.
The greatest lesson.
See, I got to tell you something that I really think about your book, okay? You wrote a book about the downfall of the economy and the down and the crash. But when I closed the book, I thought, okay, this was the day that America grew up. This is the day where America said, okay, we're going to get a leader in to put a welfare system in and to provide a safety net for the indigent. This is the day that America is going to start to institutionalize government,
Yep.
which, believe it or not, led to the institutionalization and mechanisms that allowed us to win the war, which set up 80 years of tremendous prosperity for the West. So it's a weird thing, but it was a very bad thing that happened, Andrew.
But it was
But
a great
it's
lesson.
and it set us up,
It set us
okay,
up.
for what
That's what I
Henry
meant.
Luce once said was the American century. So
Yep.
anyway, I congratulate you on having a best-selling book. You know, my books are bestsellers, Andrew, but they're all stacked up here in my basement. I mean, that's the problem with my books, but not yours, Andrew. This one got
Thank
to
you.
the bestseller list in the first week.
Thank
The
you.
title of the book is 1929 Inside the Greatest Crash in Wall Street History. Now, it shattered the nation, but also possibly birthed the nation. And so,
I like that. I like the optimism.
yeah, I think it did. I really do. I
think
think
it
had
did.
a
I agree.
big impact. You know, I mean, I think Roosevelt looked around and said, you know, as Rahm Emanuel once said, and you quote him in 2000, let's not waste the crisis. Okay. The crisis would be a wasted opportunity. And Roosevelt looked at this and said, okay, we got to protect the indigent. And even though some thought he was a traitor to his class, in many ways, he saved his class. He saved his class from a nationalist fervor, an America First movement in the late 30s. He saved us from all different types of things. And it started in 1929.
There you go.
All right. Well, anyway, thank you for joining us,
Thank
man.
you.
Well,
Thank you, sir.
congratulations again.